Kia ora koutou, welcome to Shared Lunch. I'm Garth Bray. With all of the hype around AI and tech stocks, with all of that hype building up, maybe now is a perfect time to get a realistic take from someone who's been in the market long enough to remember other times when it was a little frothy, to know the difference between a bargain and a bubble. That person is Scott Phillips from the Motley in Australia, legendary stock picker. But before we hear from Scott, here's some important information that you should always consider when investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hi Scott, g'day.
Thanks for having me on Shared Lunch.
Look, we've just had a US Federal Reserve rate cut, first one in 9 months, like waiting for a baby to be born. History would tell us that after that length of time between changes in the policy rate in the US, the price of money, that we'll typically see a bit of a bounce in the S&P 500, the market and so on. And that's already at a record high, right? So how is this not a bubble?
Yeah, how long have you got? Look, let's go with the rate cuts first and come back to the bubble. The thing about rate cuts, things are any economic indicators, is the market tends to only react when it doesn't expect what happens. Jerome Powell, the US Federal Reserve Chair, had written this almost in blood and said, we will cut rates. And so it was no surprise to the market that it happened. So part of what you're talking about that increase on the back of rates is true, but I think some of it's already happened. That idea of the market anticipating the announcement, that's why we saw almost no move on the day, was because it was already built into share prices. That being said, your question about the bubble is a really good one. And I'm going to try and separate out a record high from a bubble. Because the market always hits record highs. It's the story of the last century plus on the ASX, the New Zealand Stock Exchange, the US markets. We hit new highs all the time because capitalism finds ways to solve new and old problems. And so that process, literally the creative destruction that we talk about all the time, is what happens. Whether that's a new way of doing something or a brand new thing. Think about the iPhone that's now not even still 20 years old. Think about any technology before or after that period of time that makes us more productive, makes us happier, makes us smarter, makes us richer. Those things happen anyway. And so what's really, really important to know up front is a bubble is sometimes absolutely a bubble. More often than not, a record high is simply the last high when we get to the next one. And we have set record highs for, as I said, literally decades, more than a century. We've gone to new highs and new highs and new highs and new highs because of that creative destruction, because human ingenuity, human productivity continues to advance. So differentiating between a record high and a bubble, not easy, but that is the job of the investor, particularly right now when we are, as you say, at those record highs.
So I guess if we've, I think I read somewhere else that there'd been studies of when there are these rate cuts, when there's been some time, and one of them sort of said, like, the last 22 times this happened, the market was higher 12 months later. Well, You're sort of saying, duh, it would have been higher 12 months later, probably in any case, because it just keeps going up.
Well, both, right? It would have gone up anyway, probably. I mean, 12 months is too short to say absolutely, but over any 5-year period, very, very, very rare you don't have a higher point at the end of the 5 years than before it. So, yeah, to your point, it would have gone up. There's really a bubble and exuberance, by the way. So markets always overshoot. They overshoot on the upside, they overshoot on the downside. Just what they do, because humans are human. And for your viewers, remembering that is so incredibly important. I wrote to our readers literally only today as we're recording this. I wrote to them and said, be mindful of the fact that sometimes the market is just irrational and you've just got to deal with it. You can't time the market. Now, you can see potentially bubbles. You can potentially see overreaction on the downside. I've spoken before on Shared Lunch about the COVID crash. 38% in a month and 4 days. Now, I was buying right through, and I actually think I bought roughly at the bottom. Not because I knew it was the bottom, by the way. I'm not that smart and I'm not that clever. But I bought at the bottom. Why? Because I kept buying. Because I looked at it and thought, hang on, is the future of our planet really 38% worse than it was 35 days ago? No, of course not. It was a massive overreaction. So yes, markets go higher over time. Yes, rate cuts make assets worth more. The maths of asset pricing, we won't go into it, I promise, but your viewers will have discounted cash flows or net present values. We love 3-letter acronyms, right? TLAs. So the reality is when interest rates go down, assets are worth more. They just are. So you should see prices increase. By the way, then when rates go up, assets are worth less. That's also true. But be careful about cycles within that longer time story. At what point in the last 10 years has it been a bad time to buy shares? Well, between then and now, prices have never been higher. Almost by definition, it's never been a bad time to buy shares. If you got to sell them and own them today, you've bought them at cheaper prices, at least in terms of the market indexes. So that's the long-term story. It doesn't mean they don't fluctuate in the meantime.
Might have been a bad time to sell them though, yeah?
Yes, absolutely. Buying when things are too high, be really, really careful. I'm an optimist. I'm a dyed-in-the-wool optimist. But I have to say I'm much happier being an optimistic when everyone else is pessimistic. Middle of April 2020, I am like, you know what? This feels awful, but I know things will get better because that always does. So I'm happy to be the optimist when everyone else is running around like Chicken Little. When everybody else is saying, come in, the water's fine, come and fill your boots, this will never stop, this goes on forever, this is the new normal, all that kind of stuff. I'm still optimistic, but I'm less keen to sort of throw my lot in with everybody else. I'm like, I think the future is better than it is now, but I reckon you guys are getting a bit carried away. That's that's the skill and the art over time, is trying to delineate between those two ideas.
It's hard though, right? Because so much coverage around just a couple of key stocks that sort of spring to mind here for me. Like Nvidia, obviously. I think this week the Chinese said to some of their companies, you can't buy their chips anymore. Boom, 3% drop on the share value. Oh, we're buying some Intel. Boom, we're back up again. This is a stock that's trading at more than a 50 times multiple, right? You're saying that it's, you're going to pay 50 times its earnings pretty much to have a piece of this action. That seems like an astonishing valuation, yet people are going for it.
And that's why I want to distinguish between the market and individual companies, right? When the market's sky high, there's still stuff to buy. When the market's bombed out, not everything's going to recover, right? The companies were bombed out during the bottom of COVID and then went broke. An Australian company called Mosaic Brands, great example of that, right? We had the shutdowns, the lockdowns, all that kind of stuff. When the lockdown stopped, everything else recovered. Mosaic Brands just died. Absolutely, it literally died as a company, went bankrupt. So just because the market's low, not everything will go up. Just because some companies are in arguably bubble territory, I'll get to Nvidia in a second, don't assume, I'm not saying everything's worth buying. As that exuberance, as that optimism, as that confidence continues to flow through, it's pushed some companies up to a price where I'm like, all right, well, I like the company, but dude, no, I'm not paying that price. I'm not trying to time the market. I'm not saying, I know what's happening. This is the top. And I know that in a month's time it's going to be lower, or a year's time it's going to be, I have no idea. Absolutely no idea. All I can do is try and objectively value the companies that I want to buy or that I own, and then work out of that, which ones do I buy, what do I own that I should sell? There is absolutely a future in which we look back and go, oh man, Nvidia was cheap in 2025. And before people scoff at that, I'm going to go back. I own shares in Amazon. Doesn't matter, but I should disclose it so your viewers know. Back in 2002, 2008, back in 99, by the way, Barron's, I think it was a Fortune, one of the US business magazines, led with Amazon.bomb, right? Think about Amazon today versus 26 years ago when it was Amazon.bomb, allegedly. Was it? No. Does it look expensive? Yeah, you bet. 1,000 times earnings at one point. Like, seriously, who pays that? Now, I'm not saying Nvidia is Amazon. I'm not saying Amazon's Nvidia. What I'm saying is there are times when stuff looks really expensive and it's absolutely worth paying. If you'd have paid 1,000 times earnings on Amazon at $10, they're now $300 a share. So, I'm not saying don't buy stuff that looks expensive. But to your point, when stuff is that expensive, Nvidia is the most, and by the way, Amazon was still tiny at that point, right? 1,000 times earnings, but small. Nvidia is 50 times earnings and huge. Probably the most valuable company in the US stock market, if not pretty close at the moment. At that point, 50 times earnings for the most valuable company in the world, that's asking a lot. That's all of a sudden saying, hang on guys, this thing's got to grow at massive rates just to justify the current price, let alone get gains from this price, right? Even if the price went nowhere, it's still got to grow like Topsy just to justify today's price. Do you want a 10% return, 20% return from here? Well, then you need to go plus. So yes, I agree with you. I think Nvidia looks really expensive. I'll say expensive, absolutely.
Pricey, very pricey.
Yeah, right. And so I'll shut up in a second. Let's ask another question. But really quickly, the job of the investor is not to be right or wrong. Sounds silly, right? The job of the investor is not to be right or wrong. Why? Because you can't know in advance. My crystal ball's broken, your crystal ball's broken. Everybody watching, if you think your crystal ball's working, go and check yourself in somewhere. It's not. I promise you, you don't know what the future holds. What you can do, what you should do as an investor, is work on probabilities. Right? In other words, what is the risk of a downside? What is the chance of the upside? And when you do that, you look at Nvidia at 50 times earnings and say, well, Is there some circumstances in which it's worth today's price? Yes, absolutely. How probable is that outcome relative to maybe it's not worth today's price? How probable is that outcome? When you put those side by side, I'll be really clear about that. I look at that and go, I can absolutely make a case for it being worth today's price. AI becomes massively, massively bigger. No one ever comes up with a chip that rivals NVIDIA. There's a chip shortage for the next 25 years. NVIDIA can set its own prices and it goes to the moon. That's very, very, very possible. Very possible, right? Is it likely? No. What's more likely is other chip makers catch up. Other chip makers have something that may be worse than NVIDIA, but about half the price. Okay, now we're talking. Maybe the AI revolution doesn't grow quite as quickly as we think. Maybe venture capitalists run out of money. Maybe we talked about rates, they go back up. We saw when rates started to go back up after COVID, a whole lot of Australian businesses went broke. The 1 hour grocery delivery mobs, there was 4 or 5 of them at one point, they all went broke because the venture capital money dried up because all of a sudden money was worth something again. So in those circumstances, NVIDIA isn't worth today's price. And you've got to, as an investor, say, what are the odds that I'm right? And if I am right, what am I going to get? What are the odds that I'm wrong? And if I am wrong, how much do I lose? Put those together and say, now do I really want to buy NVIDIA? Or if I own it, do I want to hold it? For me, the answer is absolutely not. Not because it can't happen, because it's not likely to happen. And probability is the investor's friend if you really think it through and try and be as rational as you can to work out what you should buy and what you should pay.
Do you, when you're working that out, can you give us some insight into what level is enough for you? Like I've heard there are some people that say, I'll work out the valuation and when it gets to about 90% or 80% or 95%, that's when I'm out. I'm happy to leave that money on the table and be wrong because more often than not, I'll be out in time. Does it vary from case to case or do you have a rule that you follow?
So I'm an investor who values quality first and foremost. And one of the rules I try and live by is I'm slow to buy, but even slower to sell, right? Now, what does that mean? Slow to buy means I want to make sure that I feel really, really, really good about what I'm buying, both from a quality and a price perspective. And if I've done that work properly, then I want to be even slower to sell because if I've analysed and I talk about when I sell it at different prices, if I've got a quality business, I want to let that go really, really, really reluctantly, right? Warren Buffett says it's better to pay a fair price for a wonderful business than a wonderful price for a fair business. So if I've got a wonderful business in my back pocket, in my portfolio, I'm going to let that go really reluctantly. I'll say two of the businesses we sold for our members or recommended they sell, got to price earnings ratios of 80 and 90 times before we recommended they sell, right? Now, which is extraordinarily high. Why did we not pull the trigger earlier? Because we kind of went, well, it's a great business. I really, really don't want to sell this. I have to. And then we went, well, okay, now I'm out. So to answer your question, I'm not a capital V value investor, nor am I a capital G growth investor. I think that the distinction is really unhelpful, frankly. People out there can do their own thing, but for me, it's not very helpful. So you asked the question. For me, it's probably 120, 130% of the value is where I sell. And someone will say, well, hang on, why would you sell? Why would you wait for more than it's worth to sell? Two things. One, back quality, and that's competitive advantage of the business, the quality of management, all the things that we talk about that another day about what quality investing looks like. So back quality. Secondly, I don't want to be so arrogant as to believe my calculation of value is so incredibly precise that I know for sure. Arrogance and ego is the investor's absolute enemy, right? So the humility I try to bring to it is, I think this is roughly right. But all the assumptions I have to put in, the discount rate, the growth rates, the terminal values, again, we're talking about discounted cash flows here, really boring on video format. But all of that stuff is assumption layered on assumption. If I change a couple of those numbers a little bit, I can justify paying 50% more or 50% less for the same company, right? So that should tell you that this is a really, really, really inexact science. It's an inexact art. It's a guess. It's a rough yardstick. So for me, I buy hopefully well. If I bought well, I want to be slow to sell, and I want to be really, really humble about how likely I am to be exactly right on the intrinsic value. And if that's the case, let it have some rope. And then yes, sell. Now, have I held stuff too long in hindsight? Absolutely yes. But if I added up every company I've held for too long and compare that against every company I sold too early, I'm still behind, right? Great example, I'll rub my nose in my own problems. Domino's way back in the day. Recommended our members at $8, I think. It went about $13, right? And I thought, oh, made a 60% gain. It was a couple of years. I'm a genius. But gee, it's looking expensive. I better get out. It went from 13 to, hold your breath, $140, right? I missed a 10-fold gain. I could have 10 other companies go to zero, and I still would have been ahead if I'd held Domino's. Don't be too quick to sell, but if you own quality And don't get caught up with your own hubris and your own kind of, I picked the stock and it's gone up, so I'm a genius. I'm going to let it keep going up. Be real with yourself, but don't. There's a great sort of saying about watering your weeds and cutting your flowers, right? Don't cut your flowers too early. Let them bloom at a time. Cut them and put them in a vase for sure, but give it a little bit of time.
So this sounds to me a wee bit like it's also bubble protection, getting back to what we were starting to talk about there.
Yes.
If you're following that kind of a strategy, you'd feel pretty confident that you're going to miss the bubble, you're not going to get caught up in the exuberance. Anything that's rising is rising because you can see a fundamental reason for it rather than just the exuberance. Am I getting close?
No, 100%. And that's why when those companies I talked about got too expensive, like, well, I love the business, I'm going to be slow to sell, but guys, come on. I mean, no, I'm not paying 50 times earnings for NVIDIA. I'll tell you, one of the companies we saw was realestate.com. Now, that one, it got to, I want to say it was 70 or 80 times earnings, something ridiculous, right? I love that business. It has got massive pricing power. It is the dominant game in town. It's really capital light, lots of recurring revenue. Its customers love spending money there because you're selling $1 million house, you want to spend $5,000 on marketing. That's an easy decision, right? It's such a small proportion. It's a great business. But investors reckon it's worth $1 squillion more than I think it is. So at that point, now is it a bubble? The other thing I will say for what it's worth is I think the bubble label, it's worth being aware of, but it can be a little bit unhelpful. Because then we argue about is it or isn't a bubble. I don't know. All I know is it's worth more than I think it should be. And that's enough for me. I don't have to say bubble tick. I just say, would I pay that price now? No way in the world. Do I really want to hold it at this price? No. Maybe it goes up, maybe it goes down. I don't know. What I do know is probabilistically, we started talking about, a lot's got to go right and nothing can go wrong. That's not a good bet. So at that point, you take some money off the table. That is bubble protection, as you say. Because I'm not saying, well, whenever it's going up, I'll keep holding it, or the crowd must be right, so I guess I should keep holding the shares, or everyone's excited about it, I guess they must know something I don't. Don't try and keep up with the Joneses. Don't take money from don't take tips from your taxi driver. Don't listen to your brother-in-law who's getting rich owning something that no one else wants to own. Because as you say, we've been through it. The dot-com boom and bust was a great example. Another quick example, Warren Buffett. The patron saint of investors, way back in '99. I speak about magazine articles. A great article you can still find on the internet called "What's Wrong, Warren?" And the idea was Warren Buffett's missing out on this boom, and everyone's saying, "Oh, Buffett's lost it. It's all over. What does he know? He's old-fashioned." 26 years later, still on top, still doing his thing, still a very good investor. What was wrong? He saw the bubble. he saw the fact that it wasn't worth buying. Everyone else was saying, "You're missing it, Warren. Look, all the prices are going up. Why aren't you playing our game?" He said, well, I buy stuff when it's worth buying. I sell it when I want to sell it. And if there's nothing to buy, I'll stay in cash. It's not difficult. It's not sexy. It's not fun. You don't get the headlines. You don't feel excited because I own the new cool thing. But it's a nice way to make money.
I guess people might have said the same thing about Larry Ellison until about 2 weeks ago. Gosh, here's a guy who had a pretty successful company and he tried to run a few America's Cup defences as well, but so long, see you later. 40% off the basis of one earnings report, basically saying, I think to read the press, it's, most of it's supplying capacity to OpenAI. So that's a pretty strong one-way bet. And yet the market seems to love it. That seems to be pretty out of whack, surely. If a stock can leap in value 40% on one earnings report.
Great example. By the way, it was already up 40% for the year to date. So up 40% over the previous 8 months, and then up another 40% on top of that on one earnings report. What does share price means? It's the value of every dollar worth of cash flow from now to eternity, discounted back to allow for the time value of money. And I know that's complex. I'm going to leave it there. Other than to say, when shares go up 40%, what you're actually saying is the value of all of the future cash flows from now to eternity are now in aggregate 40% higher. Not this month, not this half, not this year, not the last 5 years, not even the next 5 years, but from here to eternity. Everything in total is going to be 40% more.
That horse has got to win all of those races from now on, basically.
At that elevated level, exactly right. It's up a weight class, it's up a speed, all those things, correct. And so if you don't do that, and that's not to say the earnings results were great. Very good earnings result, great announcement, all things were good. But to imagine that is now permanently and unequivocally be higher forever from here can't be. Again, I mentioned NVIDIA. What if someone else enters that cloud, the cloud race? What if someone else takes some share off Oracle? What happens to the share price then? Let's take Microsoft. Microsoft in 2000 fell in the dot-com crash. It took 15 years for the share price to get back to where it was pre-dot-com. It was a great business. It went on to even bigger and better things. It was a fantastic success story. but you can't pay just any price. There is such a thing as too high a price for even the very best business in the world. So making sure you're paying a good price for the company, even if you know the future is bright, even if Oracle is much bigger in 10 years' time. Is it 40% bigger permanently? I don't know. Is that really worth paying for? And do you want to take that bet, given there is risk that maybe it's not? Back to probabilities. So be very, very, very careful getting caught up in the euphoria. That's the thing about bubbles. You ask about bubbles. I suppose the key thing to look out for is actually not so much the companies or the share price or the results. It's the sentiment of the crowd. When everybody else is excited about it. When, the time, as they say, a great story of the Great Depression, and I can't remember who it's told of, and apparently it's apocryphal anyway. But the idea was basically this particular, Titan of Wall Street. When he had the taxi driver pull him aside and say, "Hey, I think you should buy these shares," he's like, "Oh, this feels bad. I'm going to sell." Now, I'm not saying you should use that as the test you go with. Everyone's a shareholder these days. Everyone's an investor, but just be very careful when everyone's excited, when the tide's all the way in, when euphoria is at its peak. What could possibly go wrong? Well, that's the time to be a little bit concerned. Now, I will say, don't sell everything just because. Don't try and time the market. A bubble can go on much longer than you think it can, even if it is a bubble now. It could go up 50% then down 20%, in which case it'll still be 30% higher than it is now. So don't try and trade the bubble. Don't try and time the market. But when you're buying and selling, think about what you own. Think about how good the future is probabilistically. Think about how much you're paying for that future and work out if it's a reasonable price. I mentioned we've sold half a dozen companies. We have. We've kept a heap more because we actually think, despite some of the excitement in the market, these businesses are likely to go on beating the market over the long term, despite what's going on right now. So got to kind of keep both those things in mind at the same time. It's not easy, but that's the skill you need to develop as an investor.
It sounds like you and the Motley Fool community, you're the classic active investors. You are really getting in there into the weeds. You're looking closely at what each company's performing. We've seen obviously a trend towards automatic diversity is the word I'm looking for here. Products like ETFs. I mean, is that reducing the risk, or would you say there's some sort of concentration risk building up there that people need to be careful of there when they're buying those kinds of products?
Now, I love passive ETFs. I'm an active investor, as you say. I'm a stock picker. I don't mean active. By the way, there's active and there's active, right? I'm not an active trader. I don't buy, sell, buy, sell, buy, sell. I'm active in the sense that I'm trying to find companies that I think will beat the index. If I buy company X, I buy X, I think in 5 years' time, it'll be worth more and hopefully grow faster than the market. That's my version of active. But I love passive investing. You see the fund managers out there, by the way, who tell you that ETFs are destroying the market. Absolute rubbish. Complete and utter nonsense. Passive ETFs are wonderful, wonderful, wonderful things. Just they are, right? Mean less business for me? So be it. Investors are much better off than they were because a massive range of passive ETFs are available. A couple of things to answer your question. Firstly, not all ETFs are the same. Now, your viewers know that. I really, really, really dislike thematic ETFs. Not because individually some of them can't do well, but because they're sold as panaceas. AI is going to be huge. Here's my AI ETF. And the invitation is to say, AI is big, therefore AI ETFs are big, therefore I should buy the ETF. Couldn't be further from the truth. So I despise thematic ETFs because of the way they're sold. And g'day to anyone selling ETFs out there. I love the plain vanilla index-based low-cost ETFs, the Jack Bogle Vanguard style ETFs, ASX 200 or 300, S&P 500, MSCI Global. Those are the great, great, great ETFs because they are low cost, because they track the index. They're not trying to make bets. They're not trying to get you to make a bet on AI or robotics or lithium or Bitcoin or gold.
Even with the concentration that you're getting from Mag 7, I mean, the Mag 7 companies, some of those companies are bigger than entire sectors now.
Yes, they are,
I'm pretty sure if you added up what the healthcare sector is or the, some parts of the industrials, and you go there, so you kind of are.
So yes, absolutely. And you ask about diversification and concentration. So I'm not saying don't pick individual stocks. What I'm saying is ETFs are a great base for a portfolio. And anyone who said to me, is this enough? I'd say, yes, absolutely. Do I think you do better by picking stocks? Yes, absolutely. But is that enough? Yeah. If you're young enough, if you add regularly to a handful of diversified index-based ETFs, you'll retire very, very, very comfortably and be very happy you did. I have no doubt I can't make promises, I'm not allowed to, but I have no doubt you'll be very happy with what you did, right? So, back to your point about concentration. I wouldn't just own a US ETF. Same as I wouldn't just own an ASX ETF because we got an index full of banks and miners. But if I had a global ETF or a range of ETFs, you might have an ASX 300, you might have a developing markets, you might have an emerging, developed markets. If you got that diversification by currency, by geography, by industry, then yeah, you start to put together a portfolio that is diversified. Here's the other thing. When you buy an ETF, don't just put money in an ETF once and be done with it. If you're dollar cost averaging, adding regularly, maybe in hindsight we say, you know what, September 2025 was a massive bubble. But if you've been adding monthly over the last year, 2 years, 5 years, 10 years, add all that up. People say to me sometimes, oh, the market hasn't recovered from the highs of 2007, or it's not as high as it was in whatever. If you'd only bought shares on that day, maybe I'll talk to you about it. But if you did, you are the unluckiest person in the world. If you'd have been buying every month for the 3 years before and the 3 years after, you are up massively on that point. So is it diversified? Yes, if you buy one ETF for one index and you buy it once, you're absolutely rolling the dice. I still think you'll do very well, by the way, but maybe not as well if the market was lower. If you're adding regularly to a range of ETFs, and you're adding to that regularly every payday or every month or every quarter over 5, 10, 15 years, I mean, think about it. If you do it every month for 15 years, what's that? You've made 180 different transactions over that period of time. Have you bought, one of those is going to be at a bubble, probably. One of those is probably going to be at an absolute low. Most somewhere in between, but overall, I'll go back to the Vanguard Index chart. I know your viewers have seen it a million times. Google Vanguard Index chart if you don't know what I'm talking about. Yes, you might have bought it 2007 at the peak. Then you bought in 2009 at the trough. You might have bought it 1999 at the peak. And then at 2001 in the trough. You probably bought it in 2020, March 2020 at the peak. And then again in April 2020 in the trough. And where are we? We're at record highs. Sometimes you'll buy at high prices, sometimes at low prices. I'd love to know which ones were which so I can not do it, but you can only do that in hindsight. And in hindsight, by the way, we're at record highs. Every point before that was worth buying shares at.
Yeah. You touch on an important point about regularity, and I know that people are always looking for a comparison or a metaphor, and people talk about it, the marathon approach. It's you're trying to, but if you've ever actually done any, I don't know if you've done any running, I've done a little bit in my time. The hardest thing is just pulling on the shoes and getting up and doing it 3 or 4 or 5 times a week and sticking with that. And that's the bit that pays off almost more than anything else. So that is quite a crucial part, isn't it? It's just getting that kind of regular habit built in so that you're in that market.
Can I go one step above that actually? Putting the shoes on 5 times a week is really, really hard. I absolutely feel that pain. Investing regularly is even easier than that. I can decide in advance to put the shoes on. I've still got to put the shoes on. If I decide I want to invest regularly and I tell my pay office, my payroll manager, or my bank, please do this for me on this date, I don't have to pull on the shoes. Someone else puts the shoes on for me. And that is what's beautiful about pre-commitment and automation. You automate that process so that if you've got a company that allows it, you tell your payroll manager, please put 90% of my pay into my savings account, please put 10% of my pay into my investing account. And then on payday, it just happens. You don't have to pull the metaphorical shoes on, but that's the beauty of pre-commitment and automation is you're 1,000,000% right. You can actually get out of your own way. And now, if your payroll office won't do it, tell your bank. I get paid on the 15th of the month, or every 2 weeks, or every week, or whatever it is. On those days, please take X dollars out of my savings account and move it to my investing account. And as long as you do that and just let it happen, by the way, you won't miss it because it's never there. It happens automatically. Every time you get paid, go, well, I really want to go and buy a pair of jeans or go out for dinner or buy a dress or buy a computer or do whatever your thing is. You got to choose to take that money out, put it over there. Oh, I don't know if I want to. I'll do it next month. If it does it automatically before you even get to it, that's just beautiful, and you can absolutely make it happen. It's why superannuation for Australians particularly is important, because that happens for us. Literally, the government says you can't have it. Bad luck. 12% of your pay goes straight over there. And so those kind of forced savings or automated savings, it might suck at the time. You might want the money to buy X, Y, and Z. I have not heard a single person in Australia say, gee, I'm unhappy the government made me save my superannuation. Never, ever, ever have I heard anyone say that. They're always like, I hated it at the time, but gee, I'm glad. And that's a really nice lesson.
It sounds like a great place to leave it, especially if you want to go and pull your shoes on now, Scott, and get out there and get...
Good, I should. They're just behind me over here, actually. I won't go and get them, but I can almost reach them. I really should do that.
Scott Phillips from the Motley Fool, thank you so much for giving us so much of your time and your wisdom, time in the market, and you've shared it with us today. And thanks everybody else for listening and watching along with us. We'd love to know what you thought of that and who we should be talking to next. For us, kumatu, that's Share Lunch for this week.